Hello, this is Dean Malone with Comps of X. Hope you're doing well today and you're getting some good trades. In some recent videos, I've talked about how to project where price will be the coming day by simply using tools like trend lines and Fibonacci retracement, Fibonacci extension levels to determine that based upon price history. This is one of the best kept secrets of institutional traders because they're not necessarily using all these phenomenal algorithms to determine what's going to happen. Generally speaking, these institutional traders use price history and forecast off of price history, previous highs, previous lows, to determine where price will be forthcoming. And using trend lines and Fibonacci levels can help them do that. Now, why would institutional traders want to look at price history? Well, I've often told folks that price has a tendency to go back to where it's been before. Why? That's human nature. It all boils down to fear and greed. Some fear that price won't go up any higher because it previously went up this high and couldn't go any higher and it fell back. While others have a little bit of that greed factor and say, you know what, we've reached this level. I've seen in the past where it's gone higher. I'm pushing for it to go higher. So there's a situation going on in the marketplace to where we can potentially look at what price has done and forecast or project where price can potentially be. Now today what I'm going to do is show you how to do the same thing but use the average daily range. The average daily range is the difference of the high of the day from the low of the day. And you do that over a number of days and you average it. So if you take a look at the euro dollar, you can see up here that over the last 5 days we have a 175 pip average daily range. So we expect day after day the market to move within 175 pips from low to high or high to low. However, there are going to be some days where the market's going to remain fairly tight. Like today, we see that from this low point to this high point so far for the day, we're only at about 115 pips. The previous day, we were about 25 pips. So in this case, today and the previous day, we haven't even seen the range of 175 pips. And generally when the market stays within that range, we expect a good move that third day, sometimes even a pop by that third day. But let's take the example of where we're at right now, taking the average daily range and determining where the market could potentially go coming tomorrow. Now, it's real simple. You take the average daily range from the open of the day. So I'm going to go over here to the open of the day. The open was 134.60. Okay, so that's about it right there. So tomorrow, if I'm looking at the market from this open and I project if today's market stays within the average daily range, then I'm going to take the open and I'm going to move out about 175 pips, projecting where the market could be tomorrow, and that's going to be somewhere right around 136.33. Well, if I look at the market from the downside, let's do it again here, from about 134.60 level, and I project down 175, that's going to put us right around that 132.87 level. Now, that's one way of doing it. If the market moves beyond the average daily range for the day, then look at the close of the day. So again, you would take the close of the day, you go up 175, about that 136.28, and to the downside, 132.77, fairly close to the previous numbers. That's a technique that you can do to project where the market will be. Now, let's take it one step further. For a higher probability, you would go inside that number. You would take about 70% of that number that we just calculated for a greater, higher probability move. What I mean by that is if 175 pips, and I'm looking at the marketplace, I'm saying from 175 pips, and I take about a 70% of that, I'm looking at about 122 pips from where we're currently at, up or down. Now again, the idea is to be a neutral trader and have logical processes for the market to go long or the market to go short. We really don't care which way the market goes, but once it makes a move and it starts trending in a certain direction, we have in mind a target. And that's what we're working on here, is targets for where the market could potentially go. Now, one caveat here is looking at the weekly close. This past week's close on the euro dollar is 137.52, represented by this line. Now, it is typical of the marketplace to move towards the end of the week back towards the weekly close of the previous week. I'm simply going to take the average daily range distance and add it to or subtract it from the previous week's close as a potential target. Let me show you this. So from the 137.52, if I move down 175 pips, that's about 135.77. If I move up off of that 175, that is going to put us 139.25 level. I don't think the market would get up that high unless there's some major economic event. I'm just looking at average daily ranges. So that's another technique as you move towards the end of the day. Now, for those of y'all who are unaware of what I'm showing here, I'm using the average daily range calculator by Compass FX. The average daily range calculator already calculates potential targets for the day. It also gives you for the whole week these particular levels: the weekly high, mid-low, and weekly low targets, including some extension low targets and extension high targets up above. So the market has moved from the close of last week down to a level, to another level, finally to the extension low, and bounced back and forth between the first extension low level and the weekly low. So moving back and forth. So one more caveat to using average daily range is using these levels that are already forecasted or projected by the average daily range calculator. In this case, tomorrow I have a level of 133.64, or if we move back up, 135.58. We could go a bit lower because if the market closes here and we push down 175 pips, that's going to bring me real close to my third extension low, or it's going to bring me up, not quite all the way, but up close to the midweek low of 136.55. So let me just recap a few things here. You're going to project the average daily range from the open of the day and the close of the day for the following day. Also, as you look at the weekly perspective, as you go into the end of the week, look at the previous week's close and look to see if the market will potentially move back towards that previous week's close. In this case, 137.52, there's a good chance with a triple bottom situation here that the market could turn and move back towards the weekly close. Other than that, you want to use the average daily range calculator by Compass FX to see the levels from a weekly perspective. These levels do not change. They're calculated for the whole week based upon the previous week. It gives us levels for the market to potentially go to as we trade. And this is solely done by price and what price has done before. If you're interested in the average daily range calculator, you ought to go check it out. Go to www.compassfx.com/ADR.htm and you can learn more about this tool. Not only does it give you the weekly levels, it gives you daily targets. Some of the calculations I've already shared with you in this video, it automatically does for you and does a proprietary calculation to give you a daily high target and a daily low target. And many times, day after day, either the high target or the low target is hit. If not, we expect the following day to have a strong trend towards one of those levels. Well, folks, this is Dean Malone with Compass FX. I hope some of this information will help you in your trading as far as determining where price may be the following day. Y'all go make some good trades. We'll talk to you next time. Bye-bye.